Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome. This is Money Sense on Thursday, the 11th of June. And with your host, myself, Simon Cordery. I'm really pleased this morning to welcome to the show two guests from the CFA Society of the Cayman Islands, Yves Martel and Christophe Barnett. Yves and Christophe, thank you very much for joining us. And Yves, do you just want to explain a little bit about your background?
Yes, thank you. By the way, thank you for the invite. Much
Pleasure.
appreciated. I'm from Quebec, Canada. I've been on an expat for 7 years and a half. Been on the island for a year and a half. And what I do, work for CIBC Bank and Trust. I manage portfolios on a discretionary basis.
Fabulous. And Christophe, what about yourself?
Good morning, Simon. Pleasure to be here. I was born and raised in Cayman and been a charter holder, CFA charter holder, that's Chartered Financial Analyst, for the last 3 years. And I currently work as a portfolio manager at Five Continents Financial. We're a discretionary asset management firm managing equity and fixed income portfolios.
Fabulous. And that's great in terms of the backgrounds for both your guys, because today's show is all about the financial basics, the investing basics. In other words, the what, why, who, where, which, when, all those sorts of questions that people ask who really are trying to understand the basics, the fundamentals of the investment industry. There's a lot of jargon in the investment industry. There's a lot of confusion. There are lots of asset classes that one can invest in, and even the very basics like equities, bonds, are confusing to an awful lot of people. So today's show is about trying to demystify and trying to explain some of those what should be really simple concepts to people and trying to put them into some context for everyone. So what I thought we'd do is just start off with bonds. They're probably one of the lowest risk investments someone can invest in. But before we go into that, let's just start off perhaps and say, what exactly is a bond? Why do people invest in them? Who are they? Which sort of investor are they designed for? So, Christophe, can you help us out with that question?
Certainly. So we'll start off with what a bond is. When an organization wants to get off the ground or do some expanding, they obviously need finances and some monies to do so. So there are different options. You could obviously go to a bank and borrow some money, or you can go to a group of banks to borrow even more money. But if you want to borrow a large amount of money, the best and most efficient way is to go to the public markets and borrow money through issuing bonds. And they're basically a financial contract where you agree to borrow money from an investor. They give you the money and you agree to pay interest at a certain rate. And at the end of the term, pay back the amount in full. So this has the benefit of giving the investor the knowledge of the final payout. They will preserve their capital because at the end they will get the money they put back in. Plus it gives them the advantage of regular payments through the interest payments at a known rate. And so for people who need that regular income without the uncertainty, it's a good investment. And it also, because it's a public issue, there is usually a secondary market, so the investor can get their money out before the maturity of the bond when it's due to be repaid, if they need to, without having a significant drop in the value of that bond.
So let me interject there, if I may, and just ask the question. Someone who says, okay, I'm going to invest $10,000 into a bond. I'm going to get my money back in 5 years. Is that certain? What are the risks of that person not getting their money back? What is the probability? What does one need to be thinking about when looking at that?
Well, the main risk is called default risk, which is the risk that at the end of the term, the $10,000 will not be repaid. So at 5 years, the company will say, we don't have enough money. Default risk can also cover the interest payments in the intervening time. Usually it's every 6 months. So if they were unable to pay the interest payment in one of the periods, that would also be default. To analyze the risks of default, there are what are called rating firms, which produce credit ratings. So they do analysis on the company or organization and determine the credit worthiness, so how likely they are. And so At the top of the scale, we have AAA, so those are organizations like governments, where it's virtually certain that it will pay back its bonds. Some corporations also have a AAA rating, but those names are becoming lesser and lesser, and even the U.S. government lost its AAA rating a few years ago. Now, with the next level down, which is AA plus, it's still expected that it's virtually certain that they'll repay, since they could just print money and give it back to you. But it goes down. That's just one scale with the AAA, and then go through the Bs and down to the Cs and default. Once you get below a rating of triple B, that's what's called, it's no longer investment grade, and there's sort of a drop off and an increased likelihood of default.
Okay, so someone who is a conservative investor, shall we say, perhaps someone in retirement or approaching retirement, they should be thinking about investing in these investment grade bonds rather than the more speculative sub-investment or non-investment grade bonds. Is that a reasonable proposition?
I would agree with that. So obviously the more risk you take, the more the higher the interest rate will be. So if you want a AAA, let's say 5-year, you'll get maybe, I think it's 1 and a little bit %, which is kind of depressing. But if you are willing to take some more risk and perhaps own a bond that's rated A or maybe triple B, you can perhaps get as much as 3%, depending on the individual organization. But if you're concerned about getting your money back, you should steer clear of investing in so-called junk bonds. The rate will be higher, so it's definitely enticing. You might be able to get 5%, which sounds pretty good in this current interest rate environment. But I would avoid those unless you have a very large portfolio and maybe have a small amount in those low-rated securities.
Sure, that makes sense to me. One of the things you mentioned when you're talking about bonds is the different ratings. And how does an average investor say, okay, I want to put some money in bonds. I accept, as depressing as it might be, 1.5%, 2%, 3% is all I'm going to get, but that's better than getting zero. And it's better than perhaps taking the risk of investing in some other asset class. And we'll talk with Eve in a short moment about equities, where you might lose quite a lot of money. How do they find out the ratings of those companies? So how does someone go about finding and saying, okay, I want to invest in investment grade bonds only, but how do I know if Bank of America or Citigroup is actually an investment grade? Is it easy to find out this information? Is it publicly available?
Yes, very easy. And the organizations obviously want people to invest in their bonds. And so they often will put the rating on their website. So if you go to any organization's website and look for the menu item investor relations, and they will typically have their rating there. Also, some of the rating firms themselves, they won't give you their full research reports. For that, they would expect you to pay, but they will give you the top line rating. Also, just the regular finance sites like Yahoo Finance, Google Finance, I believe, should also have it when you bring up the company and then look for the summary page.
Now, once upon a time, rating agencies and the credit ratings that they produced were almost considered gospel. In other words, if a rating agency had said, this is a AA rated bond, people could invest in that with a high degree of certainty that it really was a AA rated investment, and that really wasn't going to change much over time. But that's not been the case in the last few years, has it? I mean, is that something that investors should be more anxious about? So when they look on these websites, Yahoo Finance or whatever it might be, and they see this is a AA, should that be the end of their conversation? So they say, well, it's AA rated, therefore I don't need to do any more homework. What's your perspective about that?
Well, it's interesting because the firms themselves say that their ratings are only an expression of opinion and protected by free speech, which that sounds like a defense because they were defending themselves against bad ratings. But of course, like any advice, everything should be taken with a grain of salt. And if you have a belief about a firm and you look at the rating and it's out of line with your own research and analysis, you can certainly disagree and make your own judgment. The best protection that I find against a less than stellar rating is to first look at the other rating firms. So there's S&P and Moody's and Fitch and another smaller one called Egan-Jones. If they all have the same rating, you can take some more comfort that it's probably more robust than not. The other defense is to be diversified. So it's certainly safer to have a basket of AA rated bonds and then just to own one AA rated bond, because if that rating is off on that one and you hold and it defaults or gets a downgrade to a lower rating, that will be more damage than if you have a basket, because the likelihood of them all being downgraded or them all being wrong is quite low.
So safety and diversification is what you're
absolutely
saying
and
there.
So there are certain bond funds that group them, and you can say this is a bond fund that invests in only investment grade bonds, and so you can be certainly secure. You can even look and say, they'll say what percentage of the fund is in AA, how much percent is in single A, and so on.
Okay, so all that said, so you've talked a lot about the credit ratings and how one needs to analyze a company, and that's the probability you're going to get your money back. And the interest rate you're going to earn is going to be a function of how good or bad a company is, for want of a better expression. But there's other factors that impact bonds as well. And I had a question that was written into us which says bond prices have been rising and interest rates have been going lower and lower, despite the fact that inflation is expected to be rising. What happens if inflation does rise and interest rates by governments around the world are increased? What does that do to a bond investor? What does that do to bond prices? And does that mean that people should look at bonds in a slightly different climate, in a slightly different way given today's climate?
Mm-hmm. So the way the bond pricing works is the higher yield or the higher interest the more interest you get from a bond, the lower the starting price must be. So to go from 80 to 100 is a 25% gain, which is obviously larger than going from 95% to 100. And so the implied interest rate that you get is inversely related, they call it. So it moves in opposite directions to the price. Now that's important because in the last 30 years we've had a great what they call bull market in bonds. So bond prices have been going up, and that means that interest rates have been going down due to the inverse relationship. Now we've gone down so much that in terms of if you borrow or lend money for a very short term, the interest rates are practically zero. And even if you were to borrow or lend money for up to 10 years, it's still quite low, just over 2%, which is historically low since the 10-year interest rate is usually 4 to 6% historically. So while we have some European nations that have negative rates, let's say that zero is the lower bound. So in the next 10 years, we expect that interest rates are probably going to be higher than lower just because there's nowhere else to go. Now that means that bond prices will tend to go down. Now what does this mean for the individual investor? Well, I would say it matters in that if you buy a 10-year bond, the price may decline over the next 10 years, but you will get the amount that you invested. Because it's a fixed income, as long as there's no default, you will get the amount you invested at the rate that you agreed at the beginning. So most people shouldn't be trading bonds. So I would say that while there is a risk that interest rates will rise and bond values will go down, if you hold the amount to maturity, you will get the amount that you agreed upon. So the most important thing is to hold a diversified basket of well-rated bonds, and so you will get the money you put back in.
And that's an incredibly important point in actual fact, isn't it? That someone can mitigate against the risks of the economy by being willing or able to hold that bond until it matures. So if someone is an investor who isn't willing to hold a bond for 5 years and they buy a 5-year bond, or isn't willing to hold a bond for 10 years and they buy a 10-year bond, then they're exposing themselves to an awful lot of risks. So you've got to be prepared to accept the credit risk that you're investing in, but you've also got to be prepared to hold it until it matures. Otherwise, you could lose money because of these economic circumstances you mentioned, the impact of rising interest rates causing falling bond prices.
Absolutely. So the two important things in bond investing is to try to match the maturity of the bond with your expected cash needs. So if you know you have a big cash outlay coming up in 5 years, well, then a 5-year bond is appropriate. Or if you know that you have a kid that's going to college in a year, well, you shouldn't buy a 5-year bond. You should buy a 1-year bond because that matches the term with when your expected cash needs are. And that allows you to avoid being what's called a forced seller, where you're forced to sell because of the cash need, and you're forced to sell at a bad time when interest rates have risen and so your bond has been repriced. If you're never a forced seller and the bond doesn't default, you will get the money that you agreed to at the very beginning.
Sure. Thank you, Christoph. Now, we're going to take a break in a few seconds. After the break, we're going to come and talk with Eve and talk about equities And one of the reasons we want to do that is, as Christophe mentioned, bond prices and bond yields, are as low as almost as they've ever been, so you're not getting an awful lot of return. There is a risk if the economy continues to improve and interest rates go up that bond prices could be under pressure. So what about equities as an alternative asset class? What are equities? What are the risks in them? After the break, we're going to discuss those.
One TradeX knows there's more than one way to invest. One TradeX is the Cayman Islands' only fully licensed online broker-dealer, offering discount trading services to individual investors and traders, hedge fund managers, and family offices. One TradeX has the most competitive online trading prices of any offshore broker worldwide, with no custody or management fees, free demonstration accounts, and no charge to open an account with a $5,000 minimum deposit. Trade stocks, options, futures, bonds, and Forex. Learn more and open your free demo account today at onetradex.com. One TradeX, the Cayman Islands' #1 choice for online brokerage.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One TradeX.
And now, more Money Sense.
Welcome back. Yves, we've talked a fair bit about bonds with Christophe and discussed some of the risks they face and some of the opportunities investors can have in those. Equities are a different asset class. They have different levels of risk. And people who may not be familiar with equities, it would be quite useful, I think, just to talk just the very basics. What is an equity? What risks are there? And then once we've talked about that, we can perhaps talk a little bit about what risks are being faced today and such like. But just help us out to starting this conversation with what is an equity? What does it do for an investor? What sort of investor should be investing in them?
Okay. As Christophe said at the beginning, when you buy a bond, you lend money to the company, and the company gives you back the money when the bond matures. When you buy a stock, or same word as equities, you own the company. So just to take a very simple example, somebody will launch a new business, a very small business, will put money in the business, so he will own the company itself. As the company grows, that person might need more investors, so each person that will put the money in will own a share of the company. And as the company grows up, one day they might decide to go public. So going public means that the stock or the equity will be traded on a stock exchange, and then you've got lots of investors that buys. In terms of risk, it's just common sense. The smaller the company, the riskier the company is in the industry, then that will be the riskiest. Just to give a small example, if you go or you drive on 7 Miles Beach, you see lots of companies. You might see smaller ones or the big hotels. So the risk of the ownership will depend on the size of the company and on the industry.
Okay, so an investor who is considering investing in equities, well, how do they go about doing it, and what should they be thinking? What should be at the back of their mind? Should they be saying, okay, I should just go out and these 5 companies I know, I'll put all my money in these 5 companies, or what should they be thinking about when they're trying to invest in equities?
Still, it's the big common sense, and same thing as Christophe said, you need to diversify. The more you're diversified, the less risky is your portfolio. And there are many ways to invest. You can go directly, open an account with a stockbroker or a discount broker, or you can buy mutual funds. This is at any local branch or investment managers, you can buy them. And there will be, even if you see a fund that is called an equity fund, the risk will differ depending on how and where the money is invested.
Okay. If I put $1,000, Christophe mentioned, if I put $1,000 into a bond, in 5 years' time, I'm going to get $1,000 back unless it defaults. I'm going to be paid some interest rate during the time I hold it. Talk to us about what happens if I put the same $1,000 or perhaps a different $1,000 into an equity. What happens to my money invested in that? In 5 years' time, do I get $1,000 back? What happens to that?
There's no certainty. The company can do very well. Company can go bankrupt. If the company goes bankrupt, you lose everything. If the company doesn't do well, maybe 5 years from now, the price of the stock will be lower than the initial investment. Could be higher. Another thing that I haven't talked yet is the dividends. Lots of company pays dividends every quarter, so that's a way to get income from equities.
So, what sort of income are we talking about? I put my $1,000 in. What income am I likely to be getting nowadays? And is that going to change? Because if I put it in a bond, I'm going to be getting, say, 3% or 2% or whatever the number is, but that doesn't change over time. So how does that? What's the equation with respect to equities in that respect?
Most of the time, the dividends is a fixed amount that the company pays. So you know exactly the yield. So the yield is just the dividend that you receive per annum divided by the price that you pay. And as the company continue to do well, the dividend might increase. And that's a way that you get more income. And it's on a quarterly basis that you receive the dividend.
Okay. Now, when we're looking at investing, we were talking in the bond market, we're talking about they're good for people who want to have a reasonable degree of safety, a reasonable degree of security, because you're going to get your money back. Equities, you said, you might lose 100% of your money. You might lose 70%, you might lose 50%, you might lose 20%. You also might gain a return. So it's a different type of investor, really, that, from what you're saying, it seems to me that should be investing in equities, perhaps considered to bonds. What sort of person, in your opinion, then, should be thinking about investing in equities? And perhaps, also importantly, what sort of investor probably shouldn't be thinking about investing in equities because of the risks you talk about?
The first thing to look at is the time horizon. As Christophe said earlier, gave an example, somebody has the cash outflow a year from now, then you exclude the equity totally. If your savings for your retirement, something like 20, 25, 35 years, then you will be able to put more and more equities the longer is your time horizon. Another factor to consider is the risk of the investor himself or herself. It's when I meet with investors, with clients, I always mention the sleepiness factor. That's how much equities you should have in your portfolio. That's the one that will make you sleep not too well because you don't take enough risk. And if you lose sleep at night, then you have too much equities. So it's just the balance that each investor's.
Okay, I just want to pick up on something you said. You said that someone who's perhaps going to need to spend money in a year's time shouldn't be thinking about investing in equities. Explain to me a little bit more why that is, because I think a lot of people out who I talk to sort of think, well, I can invest in equities today, I can speculate and it might double overnight, and that's fabulous. Yeah. That's not always the case, though. So explain.
No, it's never the case.
Yeah. So that's the risk, isn't it?
Yes, that's a risk because it's the uncertainty. Equities, they outperform bonds, but it's in the long term, always. So in the short term, anything can happen, and most of the time you don't see it coming.
Right. So you could have a bad economic circumstance which causes a banking industry collapse, or it might cause a oil industry collapse, or it cause a mining industry collapse, and then suddenly you could be 30, 40% poorer just because you've invested at the wrong time. That's what you're kind of saying then, is it?
Yes, exactly. Because even if the stocks, they go up and down. I've been in that business for almost 30 years now. So I've seen huge declines, something like 40, almost 50%, just in a matter of days in the market. So somebody who had just a 1 year time horizon, he will not have time to make money back. Whereas somebody that has a longer term time horizon, then will be able to take his return on his investments.
Now, you mentioned just there that these things can go up and down an awful lot. So I think we've all probably experienced that, and you can watch whatever TV show you want, and when bad things happen, everyone's talking about equities and talking about the stock market. So let's just pretend that we all wake up tomorrow and we've invested after this show in equities and bonds, but particularly talking about equities here, and the market has a completely disastrous day. Should that be the signal to people to say, now I should sell, I should get out because I should genuinely start panicking? Things are really this bad. What should people be doing in those sorts of desperate circumstances?
Well, it's back to the fear and greed factor. People that invest usually in the equities that have high expectations, they're more greedy. And then when the stock goes down, then it's the fear factor. People just want to sell. The best thing to do is just to, if the company is good, that's why you invested first in that company. The market will come back, and the investor would not be losing the investments. The only time that you lose is when you sell. It's when you crystallize the gain or the loss.
Sure. So what you're saying is that investors should be thinking longer term and almost immune to the short-term movements, unless, of course, the reason for the short-term movement is a bad piece of company data from that company, or that company's got a huge new competitor, something like that, which is a genuine, sensible reason to be exiting that investment.
Yes.
Okay.
Right.
Now, when people are talking about investing in equities, how should they go about doing this? So should they say, okay, I'm familiar with, let's say, Bank of America, with Boeing, with, I don't know, American Airlines. I'm familiar with those companies. I know what their products are. I should invest in those. Should they be investing in a star mutual fund manager? Should they be what should they be investing? How should people get into this industry?
Well, the more diversified that you are, the less risky it is.
Okay.
But the less risk it is, just like with bonds, the less potential return that you will make. So if you invest just in a few companies that you know well, that's a good way to start. But you have to follow these companies. So make sure, as you said, maybe a new competitor can come, or the industry itself can go wrong, just like the price of gold. All the mines went very bad, all the mining companies. So that's the first way you can invest, by picking certain number of stocks. Or you can go with a fund, and most of the auditors now, they invest in mutual funds, in equities, and also in bonds through their pension plan.
Right. Okay, so what I'm hearing from both of you, in actual fact, and unfortunately we're coming to the end of the show, we'll obviously have to continue this discussion in future shows, but what I'm hearing from both of you is that when you're talking about investing in bonds and equities, and in fact almost any other asset class, just be very careful, be as diversified as you can.
Yep.
Pay attention to what you're investing in and make sure you understand what you're investing in. And then presumably there's also sense, and a yes or no from both of you, one shouldn't just invest in bonds, and perhaps one shouldn't just invest in equities. Investing in both and diversifying across different investments is probably sensible as well.
Yes, if the time horizon is longer.
And Christophe, you agree with that as well?
Absolutely. For most people, a balanced portfolio is appropriate, and always remember costs matter.
Fabulous. Well, you've got three investment people there all agreeing, which is perhaps one of the more unique circumstances in the world. So with that, I think it's more than sensible to wrap up, and look forward to speaking with everyone next month. And thank you for joining us this week on Money Sense.
Thank you.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage. OneTradeX knows there's more than one way to invest. OneTradeX is the Cayman Islands' only fully licensed online broker-dealer, offering discount trading services to individual investors and traders, hedge fund managers, and family offices. OneTradeX has the most competitive online trading prices of any offshore broker worldwide, with no custody or management fees, free demonstration accounts, and no charge to open an account with a $5,000 minimum deposit. Trade stocks, options, futures, bonds, and Forex. Learn more and open your free demo account today at OneTradeX.com. OneTradeX, the Cayman Islands' #1 choice for online brokerage.